Hi, I'm Pascal Millaire, CEO of CyberCube, and with me today I have Albert Benchimol, CEO of Axis Capital, a position he's held since 2012. Under Albert's leadership, Axis has grown its cyber insurance business to the sixth largest US cyber insurer in 2019, according to AM Best, with impressive 28% year-over-year growth. Albert, thanks for being with us.
Thanks for having me.
What have been the drivers of Axis's really impressive growth in the cyber insurance space?
Well, it starts with our DNA as a specialty insurer and reinsurer. And so it's important for us to stay ahead of developments and follow, if you would, the needs of our customers. And we're looking at the emerging opportunities, risks, and challenges that our customers either face today or we anticipate they'll face in the future. And it's very clear that the economy has changed towards one that's much more dependent on technology systems, computers, digital, IoTs, you name it. And so it's very clear that the economic activity that our customers are contributing to, that our societies are seeing, are increasingly dependent on this interconnected use of technology, use of data, use of analytics. And then on top of that, there's also significant challenges that our customers face with regard to regulatory and legal requirements with regards to data privacy and data security. So when we look at our customers, we go, this is a growing need there. And our job is, as you know, back to our mission and purpose, is, we exist to give our customers the confidence to take the necessary risks they need to achieve their goals. And they need to be dependent on data, on digital, on interconnectedness. And so that's a risk they're taking. And their dependence on that has significant economic impact. And so we want to be there, stand by them, help them get through it. So that's the genesis, if you would, of our interest in cyber. And so we started developing that, and we were growing as a cyber insurer through 2017 when we acquired Novi, a Lloyd's-based specialty insurer also. And they were also active in cyber. In fact, Dan Truman, who runs now our global cyber unit, came from Novi. And on a combined basis, we believe we've become a top 5 global cyber insurer. And so it's really been a question of learning at every opportunity. This is a new risk for us. We don't have 100 years of data. And so it's about learning, it's about training our people, it's about educating our customers on cybersecurity. And so we've been able to grow, as you point out, quite healthily over the past few years. And our hope is not simply to grow in terms of volume, but really to grow in terms of expertise and the ability to help our customers manage this critical risk that they face in running their businesses or their organizations.
Now, it's certainly been impressive growth, particularly in the cyber insurance space, but I wanted to touch on the cyber reinsurance space as well. Axis has a distinctive business model, as many people listening in today will know, as a hybrid insurer and reinsurer. And when you compare that top 5, top 6 place in the cyber insurance space, you see a far lower profile on the reinsurance side. So I'm curious, was that a conscious corporate decision to be more cautious on reinsurance? And if so, what was driving that?
It is absolutely a conscious decision. And it's purely a risk management issue. As I'm sure we'll discuss during this conversation, there are huge aggregation issues with regard to cyber exposures. And there's only so much that any company can take on its own on a net basis. And so the question for us was, how much of that capacity do we want to allocate to our insurance or our reinsurance operations? And given our leadership in cyber insurance, given our thought leadership, given the practices that we had, given the risk training that we give our customers, all of those, it just made sense to us to be concentrating our appetite on the insurance side. Now, to be clear, that doesn't mean that we don't participate in some cyber reinsurance treaties, but the bulk of our capacity is reserved for the insurance side, where we think we can have a significant impact on the industry.
So let's talk a little bit more about accumulation. As the cyber practitioners at this virtual conference, we'll be discussing topics like NotPetya and WannaCry, other near misses. Now, if this is a topic of high focus within the cyber insurance practitioner community, I'd be curious to hear to what extent have those sorts of accumulation events hit the radar at the C-suite of an insurer and reinsurer like Access.
Well, if you think that this is a concern for the practitioners who don't actually have to pay out if there's a loss, imagine how much of a concern it is for those of us who have to pay out if there's a large loss. So I think risk management comes hand in hand with underwriting if you're in the insurance and reinsurance business. And to your point, we have to recognize that cyber risks are one of the very few risks that have no boundary. It's not like cat, where you can have a windstorm coming up the east coast of the United States and you go, okay, my Japanese cat risk is not going to be touched by that hurricane. Or a wildfire in California, and you go, okay, that's not going to touch my Mediterranean earthquake accumulation. What we've learned is that if you have a concerted attack of some sort, it can reach across boundaries, across oceans, across time. The insurance industry has learned a lot in 2020 with the COVID. And in many cases, we all had models about pandemic this and pandemic that, but I would argue that probably most of the industry didn't quite recognize the full extent of what it could do, not simply in terms of shutting down a business here or there, but the total impact on the economy, given some of the responses that governments have had. And I would argue that the way we think about cyber accumulation is COVID on steroids. Right. Because the thing about COVID is it is a natural occurrence. It is an accidental, natural occurrence. And a virus doesn't aim for one country or another. It doesn't aim for a rich community or another. It's natural. I mean, we've seen so many times hurricanes approach Miami and make a turn. There's no malicious intent in a hurricane. Unfortunately, the developers of WannaCry, the developers of NotPetya, the developers of sophisticated ransomware, they do have a malicious intent. They do aim at the most vulnerable and, frankly, the deeper pockets area. And so we have to assume that we are fighting very well-financed, very intelligent actors who are looking to create the most harm. And so we have to be very cautious when we think about accumulations and aggregations.
Now, I guess building on that, when thinking about the pandemic, I think one of perhaps the benefits of the current pandemic that we're in is particularly post 2006. There was a lot of work done in the insurance and reinsurance area around bacteria and virus exclusions. Yep. So although clearly this is a very live issue in terms of pandemic, particularly pandemic business interruption, I'm curious to get your perspective on how well you think the P&C insurance industry is prepared on the silent cyber business interruption that may ensue.
There are a couple of issues to talk about here. So I think on silent cyber, there's a growing awareness that the insurance industry cannot afford silent cyber, which is the reference to some of the COVID language. And in fact, there are a number of steps to be very explicit one way or the other. So Lloyd's, for example, came up last year with a requirement that, and in fact was driven by the PRA, that you be explicit about whether it is covered or not, but you can't leave it silent. And the reason for that is you could end up in a situation, just like with COVID, in the UK, where you have to go to court, where the regulator has to get involved and start to interpret these words. And it's incredible how much litigation there is and uncertainty. And ultimately, I think one of the real harms of that is that it has impaired the value of the insurance brand. People go, I paid for insurance, my business was interrupted, why is it not covered? Well, it's quite clear what we offered you, right? It was business interruption post physical damage, and clearly without an exclusion. When you've got that kind of clarity, you could be disappointed, but at the very least, you don't have confusion. And I think we have the same thing here. We need to be very precise about what it is that we are providing cover for, under what conditions, under what limits, sublimits, retentions, and so on. And the more we have clarity, I think the more it creates better understanding. It's the old expression, good fences make good neighbors, right? So if we both know what it is that we have agreed to, then we'll do well together. The other issue is taking that lesson, moving it now to cyber. Wouldn't it be great if we could say, great, we'll cover you for all of your accidental loss of data, accidental loss of system use, but there's a virus exclusion. My guess is that right now customers may not see full value in a virus exclusion. And so we would have to figure out in negotiations with our customers, how do we give more capacity to more people, and yet at the same time, as individual companies, retain a reasonable amount of risk in the event of an unlikely but possible accumulation and aggregation event.
So perhaps building on that and building on the sizable portfolio that Axis has, what role does reinsurance and retrocession play in managing Axis's potential cyber accumulations?
The short answer is that we would not be writing as much gross cyber if we did not have the reinsurance capacity that we have behind us. We don't use a lot of retro right now because we don't write a lot of reinsurance, but on the insurance side, we've got a significant quota share in our book of business. We also have an excess of loss treated, aggregate excess of loss treaty. And we manage to our net retention. And as we grow, we're going to need more partnership with our reinsurers, with ILS, with capital markets. And look, my personal view is that ultimately, for the largest aggregation events, we're probably going to need some sort of private-public partnership, whether it's a pool re or a pandemic re of some sort, but a cyber pandemic re of some sort. I don't know that there is enough capital in the industry to be able to fully support the potential amount of economic damage. And just to give you a sense of it, if you want to think about if you really thought about everybody being insured, right? Every business, every organization, every city and state being insured, how much economic value is at risk? And I would say to you that COVID-19 was a really good glimpse into how much exposure you have. Imagine if we shut down all of our IT systems for a month. How much economic value would we as a society have lost? Arguably, that's how much economic value is at risk to a catastrophic aggregation event. I'm not saying it's going to happen tomorrow. I'm just talking about the scale of it. And so we're going to need a significant amount of support to be able to provide, good quality, meaningful sized coverage to our customers.
Look, I think that's absolutely right. And to your earlier point, if that's true today, it's hard to imagine that not increasing substantially in the years ahead with Internet of Things devices, the digitization of the global economy, and the increasing connectedness to the internet. So let's kind of delve a little bit more into those alternative sources of capital. And in particular, I wanted to get your take on the ILS market and alternative capital in this space. What do you think it's going to take to unlock that capital, to actually bring that capital to bear, which you've pointed out is a key enabler to the future of this market?
So let me start with the premise, with the statement that we're big believers in ILS. We're big believers in capital markets, participating in insurance. And in most cases, those participants view insurance and cat insurance in particular as being a diversifying risk, which has a really good place in their portfolio, which is why almost every pension plan of any size, any sovereign fund of any size has an allocation to ILS. On the other hand, we have to recognize that at the tail, cyber risk is highly correlated with the economy and capital markets. And so I think that we have to recognize, first of all, that there may be less appetite in the near term in ILS markets for economically related risks than non-economically related risks. They don't provide the diversification that investors would seek. But there's probably going to be a number of investors who are interested in it. So what are we looking for? More standardization, I think, is really critical. Definition of what a risk is. It took 20 years, for ILS to really become a significant part of the cat market. And frankly, they've pushed the cat market to be more data-driven, more accurate, more standardization around models, definitions, wordings. So I think the more you have that, the more the ILS markets would be interested. So that would be the first one. And the second one is it's got to be an adequate return because it's not going to be as diversifying a risk. So it will need to compete with other capital markets risk return opportunities. Maybe not on a one-to-one basis, but I think probably if I were an ILS investor, I would probably give cyber risk less diversification benefit than I would give cat risk.
You also mentioned public-private partnerships. I was hoping you could elaborate in what kind of a future you see for such partnerships in the cyberspace.
So I want to be clear that at this point in time, I'm speaking on behalf of myself, and you and I are having a conversation. I'm not representing an industry association. And the other thing is, as the CEO of a global company based in Bermuda with customers literally all over the world, we have a very high level of respect that each country, each region, each culture approaches risk and risk transfer differently. Some people believe that the government has a role to play in everything. Some people believe the government doesn't have to play a role or should never play a role. And I want to be clear that as an international company, we will respond to the needs of individual markets. And so that's the first statement that I want to make. But what I would say is that there are a significant amount of risks that we can absorb as an industry. But then there comes a point where the industry's capital is put at risk. We had exactly the same situation with COVID again. People were talking about the economic risks and why isn't the insurance industry, providing coverage even if the words didn't say so. And the answer was, in the US at least, we were talking about literally within 1 or 2 months worth of claims payments, depleting the entire capital base of the insurance industry. Again, so imagine that kind of aggregation on a cyber failure. There is not enough capital. So the industry in itself should take a healthy amount of risk in terms of their capital exposed. What do you do beyond that? Beyond that, I believe ILS and capital markets can certainly provide a significant amount of incremental capacity at some cost, but there will be capacity available. But I would argue that even if you add all of the dedicated capacity that the insurance industry, when I say insurance and reinsurance industry, are willing to provide, and you add ILS, I would argue that there is probably some scenario, and I don't know if it's a 1 in 75, 100, 150, 200, but there is a scenario where there is more loss than even that. And if a government wants to ensure that its industry is adequately protected 99% of the time by the industry, it may be required to participate in the loss in the 1 in 100 or the 1 in the 200 scenario. Because if it doesn't, then my expectation is that the industry and the ILS markets will take a much smaller percentage of the available market. And therefore, even in a 1 in 5, 1 in 10, 1 in 20 scenario, the economy will not have as much coverage as they need because frankly, the insurance industry was applying prudent and proper risk management.
Look, and this is certainly a very large risk that includes very large tail risk, but it's also what makes this such an incredible opportunity for the property and casualty insurance industry, not just to meet the needs of the clients that you mentioned at the start, but also just to become more relevant in transferring the most relevant risks to the global economy today and certainly 10 plus years from now, even if that's going to require collaborations between insurers, reinsurers, capital markets, perhaps public-private partnerships and those data providers and analytics providers like CyberCube that work in this ecosystem. Albert, thank you so much for your time. Fascinating discussion. Really appreciate you giving us your perspectives.
It was a pleasure. Thank you so much.